My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. I'll do my friends. I'm just trying to make a little money. My job is not just to entertain, but to explain what the heck's going on here, because it's crazy. Call me 1-800-743-CBC. Tweet me at Jim Cramer. All right, that's it. I give up. Bitcoin, you win. There, I said it. Now you can either say I just called the top in Bitcoin or say Cramer's given up on stocks, just wants to swap into something that's moved bigly since July 27th when the president-elect gave you the high sign to buy. So in a day where the Dow lost 248 points, S&P dipped 0.19%, NASDAQ declined 0.18% after Bitcoin trounced the $100,000 level last night. Before pulling back today, I want to discuss Bitcoin. Really, I do. Not to the detriment of stocks, but in addition to stocks. I come to praise Bitcoin, not bury it. First, let's dispel the idea that I've never believed in Bitcoin. Now, if you search YouTube, you can see that I first bought Bitcoin on September 15, 2020, when it was at just over $10,000. So no, top caller me? No, not here. Oh, and for the record, back in April 2021, I decided to participate in an auction to buy the NFT for the iconic Is God Dead Time magazine cover from April 8th of 1996, even though I had no idea what a fungible token was, let alone a non-fungible one. The transaction had to be done in Ethereum, so I dutifully bought an undisclosed amount of Ethereum to try to win. I lost the auction, but I forgot to sell the Ethereum. And when I discovered the error, it had appreciated so mightily that I was able to cash out and buy a large farm in an undisclosed location. So you may think I'm calling the top by celebrating Bitcoin at $100,000. I say, au contraire, mon frere. I've been recommending it for years, just like I've been bragging about getting lucky in Ethereum. I call it brag because it's better to be lucky than good. Still, I found myself struggling to feel relevant this morning while talking to my partner, David Faber. We were right over there. So this is where I go. You probably don't realize it. I was right over there, okay? I was on Squawk on the Street, and I was really down. I was glum, chum. You know what I was thinking? I was thinking, like, wow, wait a second. Am I ever relevant? Focusing on stocks like Signet Jewelers, down over 11% today, or Kroger up 1%, when there was crypto money being given away by President-elect Trump. On July 27th, he told you that the federal government would go all in on Bitcoin if he won. Back then, Bitcoin stood a little less than 70 G's. Trump promised to establish a strategic Bitcoin reserve and make America the crypto capital of the world. If Bitcoin were a stock and you had conviction Trump would triumph, it would be an easy win, right? His endorsement was ironclad. As he said during that fabled Nashville speech, quote, if crypto is going to define the future, I want it to be mined, minted, and made in the USA, end quote. Whether or not you think that's good policy, clearly it's good for people who own crypto. Let's belabor the strategic Bitcoin reserve thing for a moment. While in Nashville, Trump met with the biggest crypto mining firm execs to talk about this reserve. If this were oil, and he met with the biggest oil execs, promised them he'd build a reserve, and then shared his plan with the public before he did it, well, you would want to bet on oil with a Trump victory. You could have bought Bitcoin at around $68,000 in July, get roughly $100,000 today. Talk about fungible. But then it hit me. Yesterday, at my colleague Andrew Ross Sorkin's Dealbook conference, I heard Fed Chief Jay Powell talk about how he believes people are buying Bitcoin as a store of value, like gold, because there's not much real transaction done in Bitcoin. I've always endorsed keeping up to 10% of your portfolio in gold as a kind of insurance against the world's lunacy. But for years now, I've also been saying Bitcoin's a fine alternative to gold for that 10% position. Why not? I think the federal budget deficit is at impossible levels. I don't be wedded to a currency backed by the full faith and credit of a country that owes $36 trillion. Sure, you might have been all in Bitcoin. You know what? Terrific. Me too. But what if I told you there are indeed other ideas hidden in plain sight in the stock market? Ideas that you could have owned with the other 90% of your portfolio that wasn't Bitcoin. Why don't we start with today? I want to say happy anniversary to Costco. Split adjusted, excluding regular and special dividends, Costco stock came public at $1.67 a share, December 5th. Yep, today in 1985. Yesterday, Costco hit an all-time high of $991. Take that, Bitcoin. Okay, maybe you weren't alive or you weren't a child and you're a child in 1985. Maybe you didn't know Costco from no-no. Let me give you 4 great stocks that, in retrospect, were incredibly obvious winners, even as we might not have known it at the time. Let's say you put $1,000 in Amazon at its IPO of May 15th, 1997. Do you know that would be $2,940,667? A bookstore online or a future retail and advertising powerhouse is one of the greatest businesses of all time, Amazon Web Services. 2.9 million, that is staggering. Well, then there's the most obvious winner of all, Elon Musk's Tesla. If you put $1,000 in Tesla at the time of its IPO, June 29, 2010, easy peasy, right? You now have $326,021. Again, too long ago? Okay, I get that. All right, what's the most loved stock in this market today? That's pretty easy. I'd say it's Palantir, which is a terrific example because that company's pretty opaque, kind of like the NFTs. If you bought $1,000 in the now obvious Palantir IPO a little over 4 years ago, you'd have $7,187, 619% return. Oh, and told you that one would bounce right back from yesterday's travails. Now, let's really go there, okay? Let's do this. Desperate to call attention to what I said could be the greatest stock ever, on June 20th, 2017, I took the extraordinary measure of renaming my dog Everest. From then on, I said he would no longer be Everest. His name would be NVIDIA! Now, if you listen to this crazed lunatic that day and invested $1,000 in NVIDIA, you'd have $37,399. That's right, $1,000 into $37,399. Simply by watching a video of a guy on the floor of the exchange, no more than about 20 yards from here, talking about how his dog responds to the name NVIDIA, especially if you have a T-bone in your hand. Which brings me to my rather harsh point. Yes, Bitcoin holders, congratulations. You got a chance to run ahead of the president-elect's promise to create a strategic Bitcoin reserve. Good for you. So in another desperate gambit for relevance, just like with the Everest to NVIDIA transition, all I'm asking is that you be somewhat diversified. If you miss Bitcoin, if you buy some today, hold it as the president-elect suggests, would it be too much to ask that you throw in some stocks as part of that portfolio? Go with some of the most obvious names. I don't care. I still like them. Costco, Amazon, the implacable Tesla, the infatuating Palantir, the canine of an equity that is NVIDIA. We own two of these for the Travel Trust, Costco and NVIDIA, so you might purchase them simply by being a member of the CNBC Investing Club. We'll even keep you updated on them. My point should be obvious by now, right? Well, we could become the Bitcoin network, especially since President-elect Trump christened us as the Bitcoin nation. I actually think there's more to investing than just owning cryptocurrencies. You got the Costco with that Musk membership card, right? The Amazon, Palantir with that wild woolly Alex Karp CEO. I love that guy. And you could own the stock of the richest person on earth and certainly the second most powerful person in the Bitcoin nation, Elon Musk. NVIDIA's no dog. It's the best of breed. There, Bitcoin's part of the most obviously diversified portfolio in recent history. Buying and holding stocks can be just as lucrative as buying Bitcoin 6 days after Biden dropped out of the race. Or maybe, just maybe, it can make you even more money. Bottom line, I say own them both, stocks and crypto. That way, if Trump ever gets around to saying you have to buy Tesla, well, you got the edge on him. And if you're diversified with Costco, Amazon, Palantir, NVIDIA, Tesla, and Bitcoin, then what the heck? Congratulations. You're rich as Croesus. Maybe richer. Well played. Darren in Texas. Darren.
Booyah, Jim.
Booyah, Darren.
First, I want to shout out to my family in St. Albans, Queens, New York. And also shout out to the Reddit Pirates Den community. Arr. This company
well, I like both of us. My wife's from Queens, so I'm all on board there. She's from Flushing, whatever the hell that is. Go ahead. Who names a town Flushing? What is that about? Okay, go ahead.
Tell me about it. Yes, this company I'm looking at has a forward PE of 15 with a 4% dividend yield and has a very popular card game underneath it called Magic the Gathering. I'm talking about Hasbro, ticker symbol HAS. What you think?
I just told someone from Hasbro the other day that I really like your stock, that it just seems to be too cheap for me, that it's gotten caught in all the hoopla of all these other stocks, and frankly, it's overlooked. I like you. You got horse sense. Must be with the thing in Queens, because I think Faber's even from there. How about Tina in Wisconsin, please, Tina?
Hi, Jim. My name is Tina. I'm from Delavan, Wisconsin, where scow sailing is just as important as cheese. Hey, Cramer, you
Good luck tonight. Yeah. Good luck tonight. Okay.
Hey, Cramer, you give it your all, and that's how my family loves you. My two college-age sons watch your show, and they love research companies because of your enthusiasm.
That's what I want. That's how people get wealthy. Now, you're going to make mistakes. We all do. But that is the prescription for wealth. How can I help you?
Yeah, well, so I started acquiring AT&T stock in 1997 through an ESOP and chose to hang on through the Ameritech and SBC partnerships because I believe in the company's culture and products. I've seen the price go down to 14 and go as high as 44. It's been a roller coaster. However, because of the dividend, I've never sold. So with CEO John Stankey's new strategy of discouraging additional debt by giving up on the media pursuits like Warner Media and DirecTV, and instead focusing on its core connectivity business, wireless and fiber networks, should I continue to be a loyal AT&T supporter and hope it can reach $44 again, or cash in now on its recent rise and not be greedy?
No. First of all, thank you for your concern and for your endorsement of what we do here. I will tell you, I want you to hold it. I think that Stankey's pulled it off. I think it's great that he changed his tune. I think the stock goes higher, and well played. All right, as we take note of Bitcoin hitting the $100,000 level, it's worth remembering that buying and holding stocks has proven to be just as lucrative as Bitcoin. You can take a little off the table if you want to. I say it's worth owning both assets, so that's my plan. On Mad Money tonight, I'm breaking down the latest earnings from discount store chains Dollar General and Five Below and Dollar Tree and seeing if the names are worth keeping in your cart after a tough stretch. Then this year, IPO's class was full of red-hot performers, but can those gains last? I'm going to tell you where I stand on Reddit and many others that have soared since joining the market. Oh, and what's ahead for fintech player Upstart after some mixed analyst commentary? I'm putting the reports head-to-head and revealing where I come down. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.
Have the dollar stores finally gotten too cheap after their massive declines this year? Since yesterday, we've heard from Dollar General, Dollar Tree, and Five Below, which is dollar store adjacent. And for the first time in several quarters, you know what? The news wasn't all that terrible. Let's take them in order. Dollar Tree reported yesterday morning, and with the stock that was down nearly 50% for the year going into the quarter, expectations weren't exactly sky high. But at least they were finally low enough for Dollar Tree to deliver a clean top and bottom line beat with 1.8% same-store sales growth. Wall Street was only looking for 1.3. At the same time, management actually raised their full-year forecast. Turns out Dollar Tree's taking market share. They've got more traffic, and customers are spending more on each visit. The traffic was especially strong at their Family Dollar sub-brand, which has struggled since they bought it years ago. That kind of struck me really by surprise. Now, all year, the dollar stores have been hammered relentlessly because they're not really dollar stores anymore. They've had to raise prices to offset their higher costs. Plus, they cater to lower-income households whose budgets we know are most stretched. Dollar Tree's found a way to cope, though, carrying more cheap food, with consumables now accounting for nearly half of their sales. That's up big. And that's what the shoppers really want. Unfortunately, the other half of the business is still discretionary, which is not in good shape. Dollar Tree also caught out the success of their multi-price 3.0 store format, which offers various price points as a way to retain their value proposition while still carrying higher margin products. Companies converted another 720 stores to this 3.0 format last quarter, bringing the total number of converted stores to approximately 2,300. These stores now produce roughly 30% of Dollar Tree's revenues, and their same-store sales were up 3.3%. Very good. Hey, get this, consumables up 6.6%. Of course, it wasn't perfect. Dollar Tree beat the expectations, sure, but the bar was pretty low. Management called out softer trends in November with the expectation that December will be impacted by a shorter holiday season. Turns out there are indeed 5 fewer selling days between Thanksgiving and Christmas this year. Doesn't help that Dollar Tree is still looking for a new CEO as well as a new CFO after Jeff Davis agreed to step down following the 10K. I say ouch. There's also the question of potential tariffs, which could do some serious damage to the whole group. Interim CEO Michael Creedon noted that when they last dealt with the trade war issue, Dollar Tree was able to, quote, mitigate the majority of the potential impact by negotiating lower costs with our suppliers, changing product specs or pack sizes, or dropping non-economical items, end quote. He went on to say that all three of these options are once again still at their beck and call, I think, but it won't be cheap. Next up, last night we heard from Five Below, another value chain where everything's $5 or less. This was good because the stock shot up more than 10% today. Although, again, it's bouncing off very low levels. What happened? Right, Five Below delivered a monster 25-cent adjusted earnings beat off a 17-cent basis, substantially higher than expected revenues. And same-store sales up 0.6%, but Wall Street was looking for a 4% decline, so that does count as a huge beat. Five Below's made a lot of progress since the total imposed in the second quarter. They actually had to pre-announce that disaster back in July, along with the news that their president and CEO, Joel Anderson, been on the show a couple times, had stepped down from the role to pursue other interests. Hey, kind of NFL speak for fired. Hey, Joel actually made the jump to Petco. Don't worry about him. Since then, Five Below has been focused on improving the value of their products and the in-store experience, and I think it's working. For a long time, the key differentiator for this business was its ability to quickly identify new trends, capitalize on them, give you kind of a treasure hunt experience for its customers. The huge same-store sales beat tells us they're back on track, with management calling out tailwinds in tech, style, and candy. Always like their candy assortment, along with a strong seasonal assortment itself, which together represents over half of the business. As for the current quarter, Five Below says the holiday season's off to a solid start, with Black Friday weekend coming in line with their own expectations, even though they face the same shorter holiday season as everyone else. Management also announced that the COO and current interim CEO, Kenneth Bull, will continue his role as COO, while Winnie Park, new name, CEO of Forever 21, will be taking the reins of the permanent CEO of Five Below. People like that. It's encouraging, but the new CEO has a tough road ahead. Potential tariffs brought in by the second Trump administration. Like Dollar Tree, they have a bunch of tactics they can use to offset the damage from high tariffs. But you see, making that happen won't be easy, because an astounding 60% of Five Below's merchandise comes from China. Finally, there's Dollar General, DG, which reported this morning. Unlike Five Below, the stock barely budged because Dollar General's results were more mixed. Better than expected revenue paired with an earnings miss, quizzical. But that's thanks maybe to the big hurricanes in the southeast. Still, Dollar General's same-store sales were better than expected, driven by a 1.1% increase in average transaction amount and a 0.3% increase in traffic. Meager, but better than expected. Like Dollar Tree, Dollar General's seen significant growth in the consumables category. Unfortunately, consumables carry some of the lowest margins of their assortment. While the quarter ended on a high note with same-store sales growth being strongest in October, management noted that the last full calendar weeks of both August and September were the weakest of the quarter, suggesting that their customers are living paycheck to paycheck still and struggling to stretch their budgets, and that is suboptimal. Management also mentioned that the heightened promotional environment persisted throughout the quarter, and they expect it to continue into the next year. Suboptimal. So after hearing from the Discount General gang, where do I come down on these? At the end of the day, most of the dollar store names got too cheap. But looking ahead, they've got some real problems. They're competing with Amazon and Walmart. They're competing with each other. And a new round of Trump tariffs could be pretty darn costly. Honestly, as I read through these conference calls, I found myself wondering, why do we need all these dollar stores? Are they really offering better value than a Walmart or a Costco or Amazon? Walmart's doing great. Why make the things harder on yourself by owning Dollar Tree or Dollar General stock? Bottom line, if I had to pick one of these names, I'd probably go with Five Below. They've got a better formula than the standard dollar stores, and I'm eager to hear more about this new CEO and what she's bringing to the table. Consider this a standing invitation to come on the show and explain why Five Below is worth getting even more excited about than I am right now. Mad Money is back after the break.
Coming up, as 2024 draws to a close, Cramer's reviewing this year's class of IPOs and giving his take on what the last 12 months of public debuts signal about this market. Next.
In this bull market, even if it took a breather today, although not necessarily tonight, you need to stay level-headed. I'm not borrowing a page from Public Enemy and telling you don't believe the hype. But I'd be remiss not to say that there are definite areas of excess out there. Think of me as kind of a traffic cop or designated driver, someone with a sober, albeit scolding perspective to balance out the relentless bullishness that we all feel. That's why tonight I feel compelled to call out another area where things are getting frothy, and that's the best performing IPOs of the year. One's like a real favorite of mine, Reddit. Once we reach December, money managers love to pile into the year's biggest winners, even if they're already up huge, and Reddit has been a part of that process. Yet the stock of Reddit, which I have repeatedly and unabashedly praised, is already up over 350% from when it came public in March. Its IPO priced at $34, opened at $50 and change, and since then it's never really looked back, surging to $153 as of today. Now, don't get me wrong. Again, I love Reddit, the stock. I love Reddit, the numbers. I love Reddit, the business. A little more mixed on Reddit, the message board platform, but only because some of those subreddits are full of people who make me look calm and balanced. Initially, I was worried this would become a cold stock, but after speaking to co-founder and CEO Steve Huffman in May, right after Reddit reported blowout quarter, I eagerly embraced the stock. Huffman's a total pro. Really terrific at his job. Since then, Reddit's reported upside surprise after upside surprise. It's a truly unique property in the digital advertising space. The best way to reach certain consumers and certain attractive demographics No one else is getting to these groups. So again, I'm giving you my credentials as a Reddit lover, not a hater. I've been a bull in the stock since May. The latest quarter report at the end of October was a thing of beauty. It's no wonder the stock surged 42% the next day. But the crazy thing is it just keeps going up and up. Technically, the stock's hit its all-time high of 158 and change on November 21st. But after a quick pullback to the 130s last week, it's found another win, back to the 150s. I say terrific, but here's the problem. With the stock now up more than triple where it was when we spoke to Huffman in May, and nearly double where it was when we last spoke to Huffman just 5 weeks ago, yeah, it's starting to feel, I don't know, a little excessive. Reddit's now valued at roughly $27 billion, meaning it's trading at 13 times 2026 sales, or 41 times 2026 earnings, but that's before interest, taxation, depreciation, and amortization. And I've got to tell you that I don't think there's any denying those levels are very rich by any conventional standard. By comparison, the social media gold standard, which is Meta Platforms, trades at just 7 times the 2026 revenue estimates, or less than 12 times the 2026 EBITDA estimates. Now, again, I'm going to caveat. You could argue that Reddit deserves this massive premium because the estimates are still too low, even after 3 beat and raised quarters out of the gate. With accelerating revenue growth, anything feels possible. But to me, it's incredibly hard to justify this kind of valuation. I think you have to agree with that. But rather than lecturing you about how the stock's too expensive, I want to explain how this happened, because it's not just Reddit. It's one example. Nearly all the best performing IPOs of the year have shot up to absurd levels at this point, in part because we just haven't seen that many deals in 2024. Scarcity value. According to Renaissance Capital, the IPO research firm, we've had only 139 initial public offerings this year. And while that's up 31% from last year, it's still down huge from 397 deals in 2021, 221 deals in 2020. Despite endless record highs, the IPO market's still meaningfully below 2019, 2018, 2017 levels. I think it's moribund. Now, some of that's because many companies were hoping for interest rates to come down before they came public, and in some ways, we still haven't gotten over the great IPO bust of 2022. Plus, the best private companies don't really have to come public anymore. They can raise as much capital as they need in the private market these days. Many people thought we'd get a huge IPO from Databricks, me included. This is a data storage and analytics play that competes with Snowflake. Deal never came through, though. And now we know why. Databricks is working on a $5 billion fundraising round that would value the company at $55 billion. They don't need the public markets. Or just look at one of the highest valued startups in the world, OpenAI. It raised $6.6 billion at a $157 billion valuation in October. Tons of funding from Microsoft, NVIDIA, SoftBank. Elon Musk's SpaceX remains private. It was valued at $210 billion in a tender offer of shares earlier this year. It's apparently weighing a similar transaction, this time $350 billion. Just like Tesla, SpaceX can now get that Trump premium, and it doesn't even need to come public to make it happen. If these companies did come public, they'd have to answer to scrupulous analysts and investors every 3 months, not to mention the SEC. The Securities and Exchange Commission is very hard on IPOs. If a small group of venture capitalists is willing to assign these companies ever-growing valuations, give them all the money they need, they have zero need or interest, frankly, to come public. I think it's way too difficult to come public in this country. I hope the new administration does something about it. It's wrong. Why does it matter? Because the great companies that do come public suddenly have real scarcity value. Again, it's not just Reddit. When you look at the 7 best performers from the IPO class of 2024, all the ones that have more than doubled from their offer price, you can see the same dynamic. There just aren't enough deals. We need more IPOs. Consider Landbridge. Landbridge is up 306%. This is a land and resource management company, controls 227,000 surface acres in the oil-rich Permian Basin. This has become one of the hottest areas of the market. Just see Texas Pacific Land Corp. Landbridge fits the bill perfectly, so the stock's more than quadrupled from its offer price. Loar Holdings up 225%. It's a niche aerospace and defense company, components maker. That's a hot area, too, so Loar has roared. Astera Labs is an AI infrastructure play. Not many of these have come public. So Astera's up 220%. American Healthcare REIT, that's a play on outpatient care, senior housing, and other hot areas in healthcare. Zoom, up 141%. Bowhead Specialty Holdings, TWFG, those are both insurance companies with premiums at their highest levels in years. These shiny new objects in a hot sector have both doubled. So when you dig into what's happening in this space, I think this froth in IPO land is a result of the fact that we simply haven't had as many IPOs as we'd expected this year. Think about it. With the best performers putting up such spectacular gains, you'd think privately held companies would be rushing to come public. But that just hasn't happened because there's so much more venture capital money floating around and it's so difficult to become public. How long can this last? At least until we start seeing many more IPOs with much more money being raised. And when that happens, you'll start seeing people sell this year's top performing IPOs to raise funds for the next big deals. That's the typical tale of the market. These IPO cycles don't run out of steam until we get flooded with new supply. And there is no more money left to buy stocks. But we're nowhere near that point, are we? In fact, we seem pretty darn far away when we're at these new highs that should be happening. Here's the bottom line. I'm begging you to remain grounded in this environment of incredible exuberance. If you're in one of these IPOs that's doubled or tripled or quadrupled, why not just sell some of your position? So you're playing with the house's money. Remember, all of these gains are purely on paper until you ring the darn register. Yes, there's a good chance that you won't make as much money because of what I'm saying, but there's also a good chance that you'll have no regrets if the market ever takes a big hit and these red hots cool down dramatically, something that now and again has known to happen. Oh, and don't worry if it happens. You can always get right back in at deliciously lower levels with that capital you took off the table. But the really great news here is that if you bought Reddit when I first recommended it, you can always take some off the table and play with the house's money, making it impossible to lose. Let's take calls. Let's go to Joe in New York. Joe.
Hi, Jim. How are you?
I am good, Joe. How about you?
Doing fine. Thank you so much for taking my call. Jim,
oh, sure.
My stock, my friend, is Oracle. Their earnings are due in a few days. I don't know. Should I hold this? What's your outlook on it?
Okay, it's funny you mention this. You know, I talk a lot about the winners of my terrible trust. I have to tell you that I took a hit in Oracle because I kept waiting for the turn to occur. But the turn is now occurring. It is up gigantically. It's up 76%. There wouldn't be anything with taking a little bit off the table. I wouldn't mind doing that. But someone might just say, Jim, you told us to get out of it much lower, so therefore my credibility is not as great in Oracle as it is in many of the stocks we talk about. But I still thank you for your trust. Let's go to John in Washington. John.
Booyah, Jimmy Chill.
Oh, man, the chill man is in town. What's happening? We're chilling here, by the way.
Hey, what do you think about Rivian stock? We're going into 2025.
I don't like the autos. Rivian, I think, is a safe bet to stay alive, which is what I care about. But as far as the common stock, I think they should keep raising money. It's really hard to be an auto company. I need to go to Robbie in California. Robbie.
Tim, booyah from California.
Booyah. Booyah. What's going on?
Well, a few weeks ago, you said to hold off on Supermicro due to accounting irregularities. But I'm going to back the truck up. What do you think?
Okay, so this is really a difficult one for me. And the reason is because of my discipline of accounting irregularities equals sell, I can't violate that. I've been saying it for a while now, and I can't deviate. There will be other people who say, you know what, it's worth the risk, but my rules that are grounded in 40 years of investing say accounting irregularities, it's just not going to be something I can recommend on Mad Money. All right, now listen, you have to stay grounded in this exuberant environment. It is an exuberant environment, please. And if you do own some of these red-hot IPOs and you got into some of them because of my relentless pushing, I'm suggesting you sell some of that position here so you're playing with at least some of the house's money. All right, much more Mad Money ahead, including my look at the bull-bear cases for Upstart after some contradicting analyst notes. Then I'm taking a closer look at today's crypto moves and giving you my latest on profit taking in this tape. So all your calls, of course, rapid fire in tonight's edition of the Lightning Round. So stay with Cramer. Lately, we've seen some crazy moves in the financial technology space. I think as people are betting the Trump administration will have a much more laissez-faire attitude on the regulatory front. Ever since the election, the fintech gains have been remarkable. Robinhood up 56%, Affirm's up 50%, SoFi Technologies rallied 37%. And those are the big boys. The smaller ones have rallied even harder. That's why tonight I want to focus on one particular fintech play that you might be familiar with from the show Upstart Holdings. For those of you who don't remember, Upstart is a consumer lending platform that connects millions of consumers with over 100 banks and credit unions that use the company's AI models and cloud software to make lending decisions. At the same time, Upstart does a good deal of lending on its own. This company came public at the very end of 2020, and it was one of the hottest stocks on the planet for much of 2021, rising from an IPO price of $20 to an all-time high of $401 in mid-October of 2021. And then it just collapsed. Like all the other hottest stocks of 2021, falling all the way to $11 at its lows in May of 2023. Even though it recovered from those levels, it took a long time for Upstart to get its groove back. By late June of this year, it was still trading at just $23 and change, barely up from its low, its late 2020 IPO price. In the last few months, though, it has caught fire, climbing to the mid-70s, including a 45% gain just since the election. I bring this up because earlier this week we saw two different analysts take drastically different positions on Upstart. On Monday, J.P. Morgan downgraded the stock from neutral to underweight,
Sell.
the equivalent of a hold to sell, even as they raised the price target quizzically from 45 to 57. Then on Tuesday, Redburn Atlantic upgraded Upstart from neutral to buy.
House of pleasure.
While nearly tripling the price target, taking it from $37 to $95. Clearly, the J.P. Morgan analysts are saying that the fund's basically over here, while the Redburn analysts think we're just getting started. Who's right? I love these analyst face-off situations because they have a way of distilling the best arguments for and against a stock. And that allows us to get to the crux of the issue. And by the way, if you own it, it gives you a lot more staying power. You'll feel a lot better. And if you don't, okay, we make your decision. Why don't we start with more negative view, though, from J.P. Morgan. This was actually part of a broader sector note. Is adjusting ratings for the 9 stocks in the analyst Reginald Smith's FinTech coverage universe. The J.P. Morgan analyst noted that the aggregate market cap of these 9 fintech stocks had increased by $67 billion year to date, with essentially all that value creation coming after the Fed's first rate cut in mid-September. While lower rates are definitely good for many of these companies, the analysts don't believe they're that good. The J.P. Morgan team didn't come out against the whole group, though. They like Shopify, the e-commerce enabler, and Affirm, which does buy now, pay later. I couldn't agree more. You know, I think both companies are terrific. But for Upstart specifically, J.P. Morgan can no longer countenance the stock's valuation. They argue that the last time the stock was in the high 70s, it was doing $13 billion in annualized loan origination volume, 8 times its current run rate. And it's true, Upstart's financials are much, much worse than they were 3 or 4 years ago. Specifically, the company has much less revenue these days. They're expected to bring in $600 million this year versus $849 million in 2021. Upstart's currently unprofitable, too, where it was printing money back in 2021. That's because people were much more interested in getting loans through Upstart back in the days when interest rates were super low. On the other hand, Upstart was a $400 stock at its peak in late 2021, but it's merely a $74 stock now. So it certainly reflects a fair amount of deterioration. And in the spirit of fairness, we should note the consensus expectations for 2025 and 2026 are much more bullish than Upstart's current numbers, including a return to profitability next year after losses in the last 2 years. As far as I'm concerned, you should be basing your stock picks on what's expected for 2025 and 2026 rather than what's expected for 2024, which is over in less than 4 weeks. But J.P. Morgan is not wrong that at the moment this company is a heck of a lot worse than it used to be. Then what's the bull case for Upstart from Redburn Atlantic? Okay, analyst Simon Clinch has got some interesting ideas here. In a convenient little summary right at the top of the note, he explains that Upstart's now had 2 consecutive quarters of positive earnings surprises with encouraging guidance to boot. Following the most recent earnings report about a month ago, he sees, quote, a clear positive inflection in fundamentals, end quote, which in his words, quote, driven almost entirely by the company's latest AI innovations, end quote, AI. Beyond that, Redburn Atlantic believes that there's still upside potential from falling U.S. interest rates, which makes sense to me. Basically, the argument is that the worst is behind Upstart at this point. As long as the Fed keeps cutting rates, that's unquestionably true. But then the Redburn analyst said he believes Upstart can get to $250 for the next 5 years. Now, that would represent a 240% gain from here. Perhaps not wanting to sound unreasonable, he merely raised his price target from $37 to $95. Now, the 30-plus page upgrade from Redburn Atlantic goes into much more detail than that, giving context for the recent better-than-expected results, offering detail on Upstart's new AI technology, also getting into some of the new growth opportunities in spaces like auto loans and home equity lines of credit. The analyst also argues that Upstart's price-earnings multiple should expand as the company goes, quote, from fin to tech. That's super funny. I'm laughing on the inside. I swear. So where do I come down on the Upstart situation? Look, I recognize that things do look better for the company today than they have really for the most of the past 3 years. But call me skeptical about the business, especially now that the stock's already moved so much. It was shocking how quickly Upstart's business fell apart when the Fed started tightening in 2022. Much of the bullishness here comes down to the fact that the Fed is our friend again. But I think Wall Street is getting a little ahead of itself by expecting a substantial number of rate cuts, which I don't think are going to happen. The economy is just too strong to merit that. If it doesn't happen, I worry Upstart will struggle to make those numbers. More broadly, I'm still not really totally convinced that Upstart's AI lending technology is all that different from what a bank using traditional FICO scores can do. By the way, I like the stock of FICO. But at the end of the day, the real problem here is we have no idea how to value the stock. Wall Street expects Upstart to earn just over $1 per share in 2026. So the stock's basically trading at nearly 70 times an out-year number that I don't have a lot of conviction in. Plus, as long as Upstart retains an interest in the loans it originates, it deserves to trade like more of a financial and less of a tech stock. Here's the bottom line. While I'm truly happy for the upstart bulls, I really am, I'm not ready to join their camp yet, especially considering how much the stock has already run. Might be worth circling back on a big sell-off, but you know what? I prefer Shopify or Affirm over Upstart, no matter what the Fed does. Mad Money is back after the break.
Coming up, Cramer takes your calls, and the sky's the limit. It's a fast-fire lightning round. Next.
It is time. It's over the lightning round. Chris Benson from Africa. Rory Sam, the stock about the life. Also, I don't know the core stocks. I do. I'm a step first. You play this out. And then the lightning round is over. Are you ready, Ski Daddy? Time for the lightning round, Cramer. Why don't we start with Sean in Ohio? Sean.
Jim, first of all, love the show, and thanks for all the hard work you and your team put into this.
Team puts a lot of hard work in. We come in early, we stay late. How can I help?
All right, Jim. So I was looking for a non-chip maker AI infrastructure position, data centers.
Sure, I get you. I get you.
And I came across a company called Verted Holdings, symbol VRT.
Here's the problem. You just came across it. Others have come across it long before. We've had them on. I know the company really, really well. And it's up like 10 times. Now, but here's what matters. If you buy some and then let it come in, you know what? I'm fine. I just don't want you to buy it all at this level because it is very high. Let's go to Stephen in Rhode Island. Stephen.
Hey, Jim Cramer, the professor.
Yeah. Oh, thank you.
First time calling.
All right.
First time calling, long time listener.
Very good. Thank you.
And what I want to say, thank you to your crew because they're the best.
Yeah,
and my stock is Sound. Hound.
Oh, my, it finally happened. Ben Stoto and I, he's our chief scientist and also researcher. We realized, holy cow, it finally broke out. I thought it never would, and all I can tell you is once they go parabolic like this, you usually get a couple more days of parabola, but then please, ka-ching, ka-ching. I could not believe it finally happened. I knew it had to happen, but it finally happened. Let's go to Reese in Pennsylvania. Reese.
Hey, Jim, my ticker is Hood, H-O-O-D.
All right, this is what I call an up stock. All right, everyone's decided that this is the fintech one to buy. They've come on, they've been highly promotional. It did an island reversal today, which I typically don't like. I think it's headed to 35. We can revisit it there. Let's go to Patrick in California. Patrick.
Mr. Cramer, thanks for taking my call.
Of course, thank you.
Hey, my question today is about Limbach Holdings.
All right, now this isn't HVAC. This is one we've been getting a lot of these infrastructure plays. There's no problem with that, but if you're going to go there, I insist on you going into train or carrier. Along with this, if you're going to own this is the spec. I like the others because they're not spec. How about we go to Glenn in California? Glenn.
Hey, Jim, thanks for taking my call. It's a pleasure to speak with you. I just want to let you know that I've been a very happy member of the club since day one.
Yes,
and I also want to let you know that because of you, I made my first purchase of NVIDIA back in August of 2017.
Well played. Well played. We made a lot of money together then. Thank you so much.
Really, but thank you for realizing the genius of Jensen Huang and bringing the company to our attention.
It's all on Jensen. He's a remarkable man. Thank you. Go ahead.
I want to ask you about the future of Skyworks Solutions. And if it's okay, I also want to ask you about Disney. Why is Disney?
All right, well, Disney, I was talking all day about that. I think it's ridiculous that someone put out a $120 target with a stock of 116. That's a buy. Skyworks is much, much tougher. Liam Griffin is an amazing CEO. I think you may have to suffer through 1 quarter or even 2 quarters before you get a turn there. It is going to take that long. Why don't we go to Trey in Texas? Trey.
Jim, as soon as you walk into my office, you see a picture of my wife and I on our wedding day, serving as a constant reminder of just how lucky I am to own a Xenia tuxedo. I mean,
as
I look
opposed
like
to meeting your wife.
Okay,
I get that. I'm a clothes horse myself. Go ahead.
I look like Bruce Wayne when I put this bad boy on. Welcome to Wayne Enterprises. My question is, do I end up with Batman money if I load the boat on Xenia stock here?
You know, I have avoided Xenia stock pretty specifically because I did not really understand it, but I noticed this bottom. That's not enough. I'm going to have to do a full workup on Xenia, in part because I'm a Brioni guy. Let's go to Joe in New Jersey. Joe.
Hello, Mr. Cramer. Thank you for taking my call.
Of course.
I've been pretty good doing some Christmas shopping, and I just want to know, with the fine line of apparel and all that I buy, is Ralph Lauren a buy up here at these levels?
Okay, I have been, ever since Patrice Louvet came in, I have just thought this was one unbelievable situation, and I'm doubling down right now. I think it goes higher. I like RL, and that, ladies and gentlemen, is the conclusion of the Lightning Round.
The Lightning Round is sponsored by Charles Schwab.
The blurring of traditional investments with any other attempts to make money has started to get a little ridiculous, I think. I mean, what else can I say when I hear that Robinhood is considering a move into sports betting? Yes, it could take the form of event contracts like the ones Robinhood put out there for during the election. Now, you may dismiss it, but the news was definitive enough to momentarily knock down the shares of some actual gambling companies like DraftKings, Flutter, Penn Entertainment, which is behind the ESPN bet. That's a statement of intent if there ever were one. First, as I said at the top of the show, I'm fine with alternative investments like crypto as long as they're part of a diversified portfolio. Look, if you insist, although I'm certainly against it, you can make daily fantasy football bets as part of a portfolio for all I care. I heard some guy on our air today who looked pretty sane talk about experimenting with some meme coins over the holidays. And I'm sure people listened and said, fine, good idea. Me, I was thinking more about buying a dividend aristocrat. Oh, I forgot. Just give me some Dogecoin. But let's step back for a second. We've been running cautionary pieces all week about the perils of being cocky when buying expensive stocks, about the ultimate foolhardiness of owning nothing but Bitcoin, or the building of a high-risk portfolio filled with the stocks of companies that lose money. I don't want you to buy stocks when the market's overbought, which is why we keep pounding that into the heads of CNBC Investing Club members, perhaps to the point of ludicrous overkill. You know why I'm a hard liner on this stuff, though? Because anything and everything can go down, like many of the great stocks that went down today. I keep stressing this point because while it all seems so easy to own winners and stick with them in retrospect, it wouldn't feel so easy if these things were going down, too. We've experienced an unprecedented run in pretty much everything. And I do mean everything. You might think now that you're a brilliant investor in whatever the heck you're invested in. And you probably feel rich, at least on paper. But let me throw in something else that you need to consider for whatever asset you think you have profits in. Whatever non-fungible token, whatever Solana, whatever Joby, whatever red or white chip stock you're up huge on, you most emphatically do not actually have a profit until you sell something. Right now, sounds like a horrendous sound, right? Jim Cramer hitting the cash register button like some old codger scolding me and making me poorer than I need to be. He's keeping me in my mythical change of poverty. I say that you need to imagine a world where assets not only go up, but occasionally they go down. Imagine a world where the bank doesn't take former profits that are now losses. I remember speaking about some stocks that proceeded to double and even triple back at the turn of the century. Lots of people listened, but they either didn't hear me when I said you had to get out now in mid-March of 2000, or they chose not to listen. If you didn't sell the dot-coms at that point, you know what? You actually lost your shirt, and you've been up huge. As my late mother-in-law always said, it was all fun and games until somebody got hurt. So go hug your kids over the holidays. Deck the halls with boughs of holly. Don't forget to buy some meme stocks and maybe even put some out for Santa when he comes down that chimney to give you gifts. He'll like them a lot more than the plate of cookies you've been putting out for him. And as long as he rings the register on his part of his position, he, too, can let the rest ride. All I'd say is always a bull market sell. I promise I fight just for you right here on Mad Money. I'm Jim Cramer, and I'll see you tomorrow.
All opinions expressed by Jim Cramer on this podcast are solely Cramer's opinions and do not reflect the opinions of CNBC, NBC Universal, or their parent company or affiliates, and may have been previously disseminated by Cramer on television, radio, internet, or another medium. You should not treat any opinion expressed by Jim Cramer as a specific inducement to make a particular investment or follow a particular strategy, but only as an expression of his opinion. Cramer's opinions are based upon information he considers reliable, but neither CNBC nor its affiliates and or subsidiaries warrant its completeness or accuracy, and it should not be relied upon as such. To view the full Mad Money disclaimer, please visit cnbc.com/Mad Money disclaimer.